In this video, we are converting two risk-related analysis. We will talk both about the risk per trade analysis as well as the maximum risk of all open position analysis. As they are similar in their setup, the analysis detects the level of risk you are exposing yourself to in the trade, either for a single position you open or combined for all positions you have open at the same time. Before we deep dive into the charts, let me spend a few minutes to talk about the importance of risk management. The first step for a trader to become successful is to secure the own funds he or she holds. There's no successful strategy in the world that does not clearly define the risk willing to take and how to manage it. The vast majority of traders fail because they miss to address the risk of their trading and run into situation of huge losses. It is more exciting and fun to focus on the potential return, of course. However, if failing to address the risk, almost always those potential returns stay a dream and will never realize. One of the most common and fundamental of risk management in trading is to specify a maximum amount of risk trader is willing to take with a position. The amount of risk is highly dependent on the own risk profile one is willing to take and on the strategy the trader applies, which influences the likelihood of a trade loss. A strategy in which the trader wins 51% of the trades and the profit in the winning trade is equal to a loss in the losing trade can be highly profitable. A strategy in which 20% of the trades are lost and a loss is twice as large as a win would also be profitable. However, the measurement of risk per trade might vary. Everyone has to choose a risk level in the end he or she is comfortable with. It all triggers down to probability. You may, of course, choose to calculate your own risk of ruin. This means the likelihood that you lose your capital based on the input factors by yourself. However, there are also plenty of helpful risk of ruin calculators out there which can be found through Google. Your input measures are the likelihood of winning a trade in percentage, your average profit for a winning trade, your average loss for a lost trade, the risk per trade in percentage of your portfolio, the number of trades, and the percentage of money from your initial capital which you would consider as the ruin. Let's take one of the examples as mentioned before. 51% of your trades are winning trade. You win the same amount in a winning trade as you lose in a lost trade. And we would say that if you lose 50% of your capital, we would consider this a ruin. On first sight, if you will be able to keep this trading forever, you can make easy profit with this. Now, if you risk 5% of your capital per trade and do 1,000 trades, you will think you make a nice profit, right? This might be true, but the likelihood that you actually reach your ruin point is up to 67%. Although you should be making money with this strategy in the long term. This is purely based on probability. Even though you win 51% of the trade, it is always possible that there are many lost trades in a row, which with a 5% risk per trade will quite quickly get you to ruin. This may be counterintuitive at first sight, but just think of the fact how often in a row there is a red when playing roulette. The likelihood of red in roulette is a little less than 50%. However, sometimes it still comes 10, 15, 20 times in a row. Exactly for those kind of scenario, you want to set a risk per trade which keeps you in business, hence has a very low probability of risk of ruin, especially because there will be additional, mostly emotional effect once you're in a strike of lost trades. Let's look at the same example, in which we win 51% of the trades, hence have a positive payoff. With a 4% risk per trade, our risk of ruin is still at 61%. 3% is still at 51%, 2% is 37%. And only risking 1% of the capital in every trade, there is still a risk of ruin of 14% after 1,000 trades. With 0.5% risk per trade, the risk of ruin comes down to less than 2%. With this in mind, it becomes clear that it is highly important to manage your risk per trade. You may have set a maximum risk per trade, and with the analysis at hand, you can track how much risk you actually took in your last trades. Let's have a look at the output chart for these two analyses: risk per trade and maximum risk or open position. In the analysis risk per trade, you see the average risk taken in your previous trades. Please note that the risk is derived based on your stop loss. The risk is based on the case that the trade will hit your stop loss and is calculated based on the capital you have on your trading account at the time of trade open. For example, if you have $1,000 on your account and your trade reaching the stop loss would yield a loss of $10, the risk of that trade will be 1%. In the chart of the trader shown here, the risk per trade in the last 20 trades was on average 0.5%, while in the last 200 trades, the risk was 1.2%. Clearly, the trader reduced the risk in the last 20 trades, maybe because he or she used the risk of ruin calculator. Let's have a look at the maximum risk or open positions. The structure of the analysis is very similar. The risk over the previous trades is shown, however, in this case, the risk of all open position is added together. For example, if you have 3 positions open at the same time, each having a risk of 2%, the total risk of all open positions is 6%. This is calculated independent of the symbols the trader is using. The trader in this example is clearly showing very high risk for all open positions, with a risk of 8% of open positions during the last 100 trades. Oftentimes, traders stick to their risk per trade rules, however then open many positions, thereby accumulating a significant risk to their account. In my personal trading, and this is just for your own reference and no financial advice, I use a risk of maximum 0.5% per symbol and maximum 1.5% for all open positions together. The analysis is well suited to track your own risk, compare against your own risk management, and adjust if required. You should always review and question your own risk management both to reflect your personal comfort and risk desire, as well as based on potential changes in your trading strategy. You can also leverage the built-in benchmark functions for the two analyses. You can see the average risk taken by profitable trader with a similar trading style as yours. Compare your risk exposure to the others and see whether you are taking higher or lower risk compared to them. You may choose to receive alerts from us in case a current position or all the open position of yours are showing a considerably higher risk exposure compared to your last trades. Activate or deactivate the alert right above the charts by clicking on the alert icon. Trading can be very demanding, and a little technical support may actually help to free your mind and focus better.